Hi there, my name is Danny Clare, and I'm a lead wealth advisor here at Flagstone Financial Management. Today we're going to be talking about charitable giving, and in particular, tax-efficient ways to gift charitably. So you might be giving cash to charitable organizations, which is great, but it might not be the most tax-efficient way to give to the charity. So let's talk about some ways that you might be able to receive more of a tax benefit for the dollars that you're already giving to charity. These strategies can be a little bit complex, so you'll want to make sure that you talk with your tax advisor or accountant. But today we'll discuss some of the high-level points regarding 4 different strategies. The first strategy that we'll discuss is qualified charitable distributions, otherwise known as QCDs. If you're over the age of 70 and a half, you can give money directly from your IRA to a qualified 501c3 organization and avoid paying income tax on those dollars. So generally, if you were to take money out of your own traditional IRA, you would owe income tax. But if you give directly from your IRA to that charity, then you avoid paying income tax on those dollars, and the charity receives it tax-free. So it's a win-win in both situations. This is particularly great when you're taking the standard deduction and you're not receiving a tax benefit on any cash that you're giving. And it can also satisfy a portion of your required minimum distributions. So at Flagstone, we have the ability to give our clients an IRA checkbook so they can write checks, and instead of it just coming out of their checking account when they give to charity, it'll come out of their traditional IRA account. So it's a great tax benefit to avoid paying income tax on traditional IRA dollars. The second strategy that we'll talk about is gifting appreciated securities or appreciated stock. So under current tax law, you can gift appreciated assets and avoid paying capital gains tax on the unrealized gain of that asset. So here's how it works. In non-retirement accounts, or taxable accounts as you may have heard them, when you buy and sell securities or stocks, if there was a gain when you sold something, you would owe capital gains tax on that gain. So for example, let's say that I bought Apple 10 years ago for $10,000, and today it's worth $50,000. There is $40,000 of gain, otherwise known as unrealized capital gains. If I sold that Apple stock, I would owe tax on $40,000 of capital gains. So for a person in Nebraska who's in a mid-tier tax bracket, that might be roughly $8,000 of taxes owed. However, if I gifted that Apple stock to my desired charitable organization, the organization would receive $50,000 and I would have avoided that $8,000 of tax. The third strategy that we'll talk about today is an account called a donor advised fund. So a donor advised fund is a separate investment account that you can establish that's specifically earmarked for charitable giving. So here's how a donor advised fund works. You can contribute cash or appreciated securities or stock to a donor advised fund. You'll receive a tax deduction in the year that you make the contribution to the donor advised fund for either the market value of the stock or just the amount of cash that you contributed to that. If you gifted appreciated stock, as mentioned in strategy number 2, to a donor advised fund, you would receive not only a tax deduction, but you'd also avoid paying capital gains tax on that appreciated stock. So it's kind of a double whammy. And then you can give to any charitable organization directly from your donor advised fund in any subsequent year. There is a more complex strategy to maximize deductions over a span of years called bunching or pre-funding several years of charitable contributions, but I'm not going to get into that in this video. Just know that's another opportunity for some more tax savings. The first 3 strategies we discussed were ways to give during your life. But the last strategy that we'll discuss is making sure beneficiary designations are set up properly to minimize how much tax is owed to those who will inherit the dollars at your death. So under current tax law, giving appreciated assets in a non-retirement account to heirs upon death will let them avoid paying taxes on the growth that occurred in that account, otherwise known as getting a step up in basis. Also under current tax law, if you list a charity as a traditional IRA beneficiary, or really any qualified retirement account beneficiary, when you pass away, they would receive those dollars tax-free at death. If you would have listed a person as the beneficiary on that IRA or qualified retirement plan, then they would have paid income tax on those dollars when they eventually took them out of the IRA. So the bottom line is there are more tax advantage ways for people to inherit non-retirement account dollars, Roth IRA dollars, and for charitable organizations to inherit traditional IRA or qualified retirement plan dollars. So again, while we don't really recommend giving charitably solely to save money on taxes, if you are charitably inclined, the 4 strategies we discussed today are ways that you can optimize how much money a charity might receive and minimize how much you may pay in taxes year over year and how much heirs will pay in taxes at your death. Thanks for listening today, and if you have any questions on the 4 strategies we talked about, don't hesitate to reach out to any of the team members at Flagstone. We'd be happy to talk through them. Thanks.